now. Hello, everybody. Welcome to the Intel REI Education Club. My name is Daniel Homland, and today we have a special guest, Fabiola. And I'll let you introduce yourself in just a moment, but I just want to give a special thank you to Fabiola because she is not only a repeat speaker, she was here almost 2 years ago. If you go to the the Speakers Hall of Fame on our SharePoint site, you'll find her talk on July 17th of 2020, so almost exactly 2 years ago. And so she's coming back to give us an update about what's been going on in her real estate business during the last 2 years. The previous person who was scheduled to speak at the spot canceled on me 3 days ago. And so Fabiola was wonderful enough to step in at the last moment and become our speaker. So I really appreciate that she did that. Before I turn it over to her, I want to show you the upcoming speakers. They're not yet all listed in meet.intel.com, but they are over here on my own personal Calendly site. So next week we have Don Spatford. He's going to be talking to us about Happy Camper Capital. He goes around investing in campsites and RV resorts. And so you're going to hear how he goes about investing in those types of properties. Then we have Isaac Weinberger. He's a cost segregation expert. And so he's going to be coming in and talking to us about what is cost segregation and exactly how does it work. After that, we have Sif. He's going to be talking about the short-term rental market, cash flow benefits. And AJ Shepard. This is going to be a special treat. I've been told I need to get to know AJ. He's actually a part of Uptown Properties, and he's located right here in Portland, Oregon. And he's got a lot of construction experience. I believe he is a real estate apartment syndicator, but he's going to give us an update on the Portland market and what do properties and the property market look like in the Portland area. So I'm looking forward to all of those. For now, though, let's hand it over to Fabiola.
Hi, Daniel, and
welcome.
Else. Thanks for having me. I know it was last minute, but it was good timing.
Excellent.
Yeah, good timing. So 2 years, a lot can happen in 2 years. So it's good to be back. And then, I also want to congratulate you too, because I've been, watching you on LinkedIn, and I think your pattern now is like every 2 or 3 months you have a big win. And I'm like, wow, you've been really busy.
Thank you.
Yeah, so when I came 2020, I had just acquired a development site. It was a former senior housing site, and the plan was to redevelop it as affordable assisted living. And so 2 years later, I'm still doing that, along with a couple of other things. Growing the acquisition side and always deal sourcing and dealing with this market dynamics that we're having to deal with. Actually, about 2 weeks ago, just before the rate hike went up, I was headed to best and final on a 230 unit. And then the rate hike happened after my offer was submitted. And it's almost like, wait, I have to backtrack. And the numbers change dramatically. Just because by the time we closed, we anticipated a couple of other rate hikes, and that's just the environment that we're dealing with. But on the development side, that project is still pursuing financing. And I would say one of the biggest reminders, not lessons, because it was anticipated that it would take a while. Construction alone for that would be like 1.5 years. And then because as a reminder, I was pursuing tax credits, low-income housing tax credits, which are subsidies that the federal government awards to each state, and the state allocates them to affordable housing projects on a competitive basis. So there is a 4%, which is not competitive, and 9%, which is competitive. And so I had the crazy idea to do a twinning, which is not that common, where you go for both credits, which means more equity. So essentially, when you're awarded tax credits by the state, in exchange, you promise to keep rents affordable at no more than 60% of average median income. So like, let's say average median income is $45,000, and HUD has set that at $45,000, your rent should be at this level. If you're at average, then 60% of that is what the bar is when you're doing tax credits. But the reason why it's favorable to a developer is because once awarded by the state, that's equity into your project. So I have a $25 million project. Like, let's say my tax credit award is about 15 million. That reduces the amount of debt that I would need. So, and that's why it's favorable, because you go from needing a $25 million construction loan to possibly only needing $10 to $15 million in construction loan in exchange for it being affordable.
Hey, Fabiola, I know since you came in at the last moment, we really didn't discuss this, but would you like to run this more as like a discussion back and forth, or do you have a presentation that you want to run through?
No, I
We can
don't
do
have
either one.
I'd rather talk to everyone and get questions in between. You know, it can be an exchange between you and I, make it more engaging.
All right, well, let's open it up. So if you want to ask a question, feel free just to take yourself off mute or put it in the chat, either way. And Fabiola, I'll try and just keep, be like a moderator, keeping the dialogue going and asking the best questions I can think to answer. And of course, if you've got a good question, jump in. So I would love to know, this project is the same project that you had 2 years ago. Is that right?
Yeah. Mm-hmm.
And were you bidding on the tax credits before you acquired it or after you acquired it, or both?
No, after. So in this, well, every state has different requirements, right? So typically there's one round. In Michigan, where this project is, there's 2 rounds, April and October. So you have 2 times a year to pursue them. Okay. There's a couple of,
Go ahead.
So I want to say there's a couple of things that you learn along the way when you're doing ground up. It's totally different from doing an acquisition, right? Value add or anything like that, even though there might be some similarities. But when you're doing ground up construction, whether or not it's tax credit or private, whatever, patient capital is important. Right? Because the amount of time that it takes, because think about all the pre-work, all the pre-development, architectural drawing, site planning, zoning, all of these things, permitting, and even getting local buy-in, even if you're not doing tax credits. Me and the city have had to become really good friends just because I need something and I need to call somebody. I have a squatter issue right now in my building. I had to call the officer from my area, right? So there's a lot of groundwork that takes place before a commercial project, especially of this size, ever happens. So, on people's end, you might see a building, wow, that building went up in 8 months. No, there's probably 3 years worth of pre-work that went into it before that building actually came up. So that was like the biggest reminder. I was already warned and reminded by a mentor, make sure that you have patient capital, make sure you have patient capital. And you're reminded of this as you're going through it.
So that's really interesting. I admittedly don't know as much as I should about low income housing. And so this is a really interesting topic. How does, first of all, let's describe the building. Where is it located? How many units is it? Give us kind of a general overall description of the project.
Yeah, so the building is 12 stories, 138 units, about 73,000 square feet. It was previously senior housing. It was owned and operated by a church that shares the same lot. And over the course of the years, maybe management operating, whatever the case may be, the church lost it. And it sat vacant for a while, and I went ahead and acquired it in 2020.
Okay, so was there another building that was ground up development, or I'm a little confused now?
It's an existing building.
Okay, it was an existing building. Okay. Yeah. Did you have another ground up development project that was going on? Oh, no. Okay. Yeah. All right. So patient capital, when you're going and doing the underwriting for taking over a building like this, how do you go about projecting what the tax benefits and the credits that you get from the state are going to be a large part of your business plan? How do you go about like underwriting and getting a educated guess as to what you'll get from them?
Yeah, so that's a good question, because not only do you have to underwrite it as a rental property, but because I was doing it as assisted living, and assisted living has a service model, now you also have to underwrite the service side, because that's essentially 2 business strategies. You have the housing portion, which could apply to any multifamily underwriting, and then you have the services side, which is totally different from rental income. So, and that's why it takes long. Underwriting tax credit projects and putting the whole package, let me just say this, anytime you're going after government dollars, they're gonna make you sweat for it. So the process is a sweat box as well. So the political side, the relationship building side, the packaging of how you piece the deal together, the compliance component, the policy, all of that is worthwhile in the end, which is why you see all these affordable housing developers out there. But if you're seeking money from government, yeah.
What do you think are the main reasons from an investor's point of view? Why would somebody want to invest in a low-income housing project?
Well, let's say affordable housing, because
I'm sorry, affordable.
Yeah. Well, because tax credits are not just low income, you have tax credits that are applied for workforce housing. So that's that middle income person who maybe still cannot do the market rate, but they're above affordable. And then you have the affordable mark, which is that person that may be below or completely below, way below the median income. But from an investor perspective, there's a few things. A lot of times with these types of projects, because you have different tax credits. So you have low income housing tax credit and new market tax credits. They're already subsidized by the government, right? So there is a lot of stability that's built into it. Your debt costs are much lower. The scenario that I gave, it's a $25 million construction. If the tax credits, let's say tax credits are awarded for 15 million, your debt is only based off of 10 million, right? The balance is though that your rents are a little lower than market rate as well. So, and sometimes that can make a big difference. I've done underwriting where the debt was just way too high. It doesn't matter how strong rents are, the debt was just too strong to carry, which is why a lot of times, as sponsors, we have to get into interest only, 3-year terms, bridge loans, just because, the debt cost is just so heavy and so intense.
Yeah. I love the idea of getting more education out around affordable housing, because we definitely have an affordable housing crisis in this country right now. And, I need to wrap my head around it, because it's a different business model, and it's a great business model when you get good at it. And so, finding people that are good at affordable housing income models is something that I think is going to be more and more popular in the future. Is 100% of the building affordable housing, or is it broken up on a percentage base where some of them could be market rent and some of them are not market rent? How does that work?
So it can be a combination based on how much allocation you want. Obviously, if 100% of the building is affordable, you get 100% of what could be allocated for the tax credits. So the next time you're in your downtown or your, midtowns, and you see a newly constructed property that looks like it should be super expensive for rent, but they always say we have affordable units, that's because they pursue tax credits. So generally, there's like at least 20% bar. So threshold. So you're going to go after at least 20% for tax credits. I mean, that could be significant in reducing your debt costs, and the rest could be market rate. But I'm in Miami. We see it all the time. This is a downtown or Miami Beach high rise, but they have, say, 10 affordable units or 20, whatever the case may be. That's because they use government subsidized funding to be able to make that affordable. In exchange, that's where the delta is between the market and the affordable rents. Now, it's a niche, right? It's not necessarily my niche. I'm a multifamily investor, but this one, the model fit perfectly for the building. The reason why you have affordable housing developers as a niche is because you have developer fee, right? And that could be $3, $4, $5 million just to put the building and the project together. And then whatever rent cash flows you make from that as well. So as an investor, that could potentially be the upside as well on that end.
Okay. When you've got tax units or tax credits available, how does that affect the debt? You've mentioned that it affects the debt several times. What exactly does it do to it?
So with this, and I can use this as an example, I'm not going out to the private market for debt. All of the debt is coming in from the state. And there is a question that asks about the 25 million, that's for construction. I had already acquired the building, so that's separate. But if you haven't acquired the building and you've tied down the building, you can include the acquisition cost of the building into whatever you need. But the state awards the tax credits. The tax credits get allocated as equity, so there's an equity investor involved, right? In exchange, the equity investor gets to buy down their tax liability, which is why they'll invest in your project.
Mhm.
You reduce your debt costs, and the state also provides debt financing. So like, let's say 25 million, the tax credit award is 15 million. There's a $10 million gap where debt is needed. You generally would not go out and go get, a construction loan from the private market. The state typically has tax bond financing to where they can finance that. So a lot of times it ends up being even cheaper than what it could be out in the market.
We actually have one property. Good Samaritan Capital is a partner in one property that has some low income housing, and it's actually in Sarasota, Florida. It's 156 unit, and 20% of those, a little about 38, 39 properties are affordable housing. And in our particular case, that we don't, and it's a Class A property. And we don't usually go for Class A properties because we're in the business of like improving them, and Class A property is already pretty improved. But in this case, it actually allowed us to qualify for a low income housing loan. And that gave us 4 years of interest only and a really cheap interest rate. And it made the whole thing pencil out. Yeah. And so it's an interesting business model to combine the two in order to get the properties of, hey, both affordable housing and better financing. So there's a lot of win-wins to combining the two.
And then let me show you the back end. So the 230 unit that I came in best and final was a tax credit property that had already reached its compliance period. So the compliance period is 15 years. And then there's like a trailing period of like 3 years, at least in Georgia, that's how it's structured. After which time you can go into market rate. So these affordable housing projects, you get in, you make your money up front on the development, knowing that you're not going to make as much on the cash flow because you're sacrificing market rent for more affordable rent. But when the compliance period ends, you see a lot of affordable housing projects get traded a lot. So this was one of them, which made it, as an investor, very attractive, because think about it. This property has floated for 15 years at an affordable rent. Like, let's say the rent is $1,000, but market rate is $1,600 today. So as the new purchaser of this property, we have the opportunity to be able to increase rents to market. Now, there's a social impact to that, right? Because you don't want to get the backlash of, wow, you're going to take lower income people and increase their rent so much. But then the business side also says the rent has been deeply discounted for so long, and the building has appreciated since then, and rents are undervalued. Here's the opportunity. And this is what made that deal so attractive to us, because it was a tax credit conversion where we would be able to convert all of the units into market rate at some point.
We've got a lot of questions in the chat. I'll go through and read them, but before I do that, I want to say, if you've put a question in the chat and you want to come off mute and ask your question, go ahead and do that. Let's throw a few more people into the conversation here. And if not, I'll just start with the first question. Oh, somebody there?
Yeah, Fabiola,
I had a question on the...
Go ahead.
All right, whoever that was, and then Ashish after that.
Okay, I had a question on the down payment because I was interested more into the loans of these kind of deals. I know maybe the SBA requires maybe 10% down, but for the regular investment properties, you put 20% down. So I wanted to understand exactly in those kind of projects, if you're dealing with the government or the cities, how do you structure the loans?
Okay, good question. So it's different, because when you're doing tax credit financing, you don't pay a down payment on it, because essentially the state is giving you equity into your deal and they're helping you to finance it. The other beauty is that oftentimes the local city, the local government may have other dollars like CDBG funds. I think that's Community Development Block Grants. They have home funds, which are like soft loans or grants into your project. So like, for example, in Detroit, where I'm building this project, the home funds is a $3 million maximum. So essentially the city can contribute an additional $3 million into the project, which buys down, again, the debt that's needed. So there's a lot of layering that happens. And so when you see these affordable housing projects, they probably got money from 3 or 4 different sources to put it together, which all of these sources helps to reduce the debt on it. Now, you have to have site control, whether you own the property outright or not, you have to have site control. So some developers might have like a long agreement with the seller. Hey, I'm going through this tax credit process. You know, it may take some time to close, and they have site control. I had already acquired the building, so I just put the building through the process. So from that perspective, it's different from commercial lending where you would have to put cash to the table. You essentially are coming to the table with, think about it as goodwill. I'm bringing a project to the community that's going to serve the community. So there's a benefit to me and there's a benefit to the community. So I'm not coming to the table with cash. And I will say that if more investors or developers were aware of tax credits, that's probably sometimes the easiest way to source funding. And not easy in terms of the process that you have to go through, but easy in terms of being able to have access to that capital. Especially when you're doing 4%, it's not competitive. So essentially, as long as there's still allocation at the state level, you can go ahead and package a 4% deal and you can get funding for that project without having to go raise money and, you know, go seek private financing, construction loan, and all of that.
All right, Ashish.
Yeah, I had a question on tax credits, but from the LP side. So I assume most everybody on this call is a W-2, and we all have these crazy tax bills that are due every year. Can you talk to is there any benefit from the tax credits flowing to an LP investor and helping reduce their W-2 or K-1 income as well, or does it just stay with a GP?
That would be a good question. I mean, from a regular real estate perspective, yeah. From a tax credit perspective, I would say maybe depreciation, if anything, as a baseline. But that's more of an accounting question, how the tax credits would flow. So let me just tell you, there is an LP involved that gives the bigger chunk of the check. So there's tax credit investors out there. They're usually institutional. So like PNC Bank they have a tax credit division. A lot of the banks that we see out here, they have tax credit divisions that invest in affordable housing. And for them, it's an opportunity for them to buy down their tax liability. So in exchange for getting the tax reduction, they invest that whatever the credit is into the project. Now, on the LP side, for people like us, the developer may need to raise capital for the acquisition, and that's probably where that could be worked out. So you can essentially structure the project to have a couple of different components in it. So you have the real estate itself, and then you have the side that finances the tax credits.
Okay, thank you very much. And what are the potential downsides for investors in these HUD / affordable housing projects?
I mean, the main downside obviously is that your cash flow looks different because you're not charging market rate rents. So that's the downside, obviously, from a cash flow perspective. But then you also have the developer fee up front that kind of helps to make up for that as well.
Great,
and that developer fee is a calculation, like it's probably like 2-3% or something like that. Every state has a different, they call it QAP, which is like a qualification application process. So every state has a different number or formula, but it could be like 2 to 3% on a developer side.
All right. If anybody else wants to take themselves off mute and ask a question, otherwise I'll just start reading the questions that are in the chat.
All right. Brett is asking, with a $25 million construction loan, does that include the purchase price of the property, or is this $25 million for renovating?
Yeah, so that's 25 million for the construction. It includes all of the costs, hard and soft costs. Soft costs would be like architectural, engineering, all of that. It includes interest. It includes operating reserves. It includes the bond fees, legal fees. It's all in.
Mhm.
Yeah.
So
and
it's everything.
it's everything. Because I had already acquired the building, I don't have an acquisition dollar amount, but if you're packaging the acquisition into it, then obviously it could include that as well.
Now, generally with a construction loan, you can pay it off ahead of time a lot faster, and it's generally for a shorter period of time, right? Can you comment on that?
Yeah, well, there would be no incentive to pay it off, right? Because you're not charging market rate rents. So typically, affordable housing developers, they thrive off of volume. That's why you'll see, like here in Miami, we have Related Group. They have tens of thousands of units of affordable housing that they do because they're doing like 10, 20 deals in a year. And if you can imagine, $3 million developer fee here, 5 here, and your debt is cut half or maybe even more than half, right? So your debt costs look different. So they thrive off of volume, and essentially they're moving on to the next deal because for them, they've made their money up front, right? They're not concerned with all of the other things.
Okay. Let's see. May is asking, what is the minimum length of time the unit has to be rented at affordable rent to qualify for the credit? What happens to the credit when you sell the property?
So the credits stay with the property because it's a restriction, a covenant restriction on the land and the property if you sell it. So the compliance period is 15 years. So just like the Atlanta deal that I mentioned, that 15-year compliance period had expired. It was built in 2004, and now it's expired, and the owner wanted to cash out and make their money on the gain from the value. And obviously from the sponsor side, there's gain as well because you can push up rents from affordable to market rate.
So there's a gain in the property value once the credits expire, and the owner can push, the market has control of the rent price then. Are there any circumstances under which somebody would sell before the credits expire?
Yeah, you can sell before the credits expired. You're not prevented from doing so. Real estate is always going to, increase in value generally, right? You just, that person who's acquiring the building has to underwrite it knowing that the rents are fixed at a certain amount. And HUD is who sets the rent for every market. So HUD has a rent threshold for this income level, this number of bedroom, this family size. And so there's like a chart that you follow. Okay, I'm building 1-bedroom units. That's going to be for a one person household, and their income at 60% is not to exceed this dollar amount. And this is what the rent is. Now, you can get project-based vouchers as well, which sometimes helps too in terms of the underwriting, because in a lot of markets, private-based vouchers are higher than that HUD threshold. What the local market would say would be considered affordable. So I've seen a market where actually this Atlanta deal, the units that had vouchers, like let's say the voucher rent was like 1,100. The units that didn't have the vouchers, the rent was like 8 something. So vouchers sometimes pay more than what affordable rent would be for that area.
Okay. And I guess I understand that you can sell before the credits expire, but I think what I'm thinking more is, hey, if I'm an investor and I want to go find a building who already has credits and I want to acquire it with my business plan being, hey, I'm going to continue to operate these until they expire, and then, the value of the building will go up. Why would somebody sell the building before their credits expire?
Well, I mean, so like this Atlanta one, he purchased it, I think like 12 million. And he purchased it like at 20 something. And then the offer amount was like in the 40s.
Okay. So he's not losing out.
Right.
Okay.
Right.
Okay. So I guess you can almost think of it as, hey, there's some meat on the bone. This provides an incentive to the buyer to buy it.
Right.
Okay. Let's see. Henry is asking, how long must you have the low income housing how long does it take for the credits to expire? I think is the
Well, it's
question.
a 15-year compliance period.
15-year compliance period and that's the same for both the 4% and the 9% credits.
Yeah, so there's 2 levels. You can do 15 or 30 year.
Okay. And Henry is also asking, how was the interaction among the tenants between affordable housing and other residents?
That's a good question. So I've never walked into these Class A buildings where they had, say, the 20% affordable to see. But here's the thing, right? Mixed income housing, communities thrive better when it's mixed income housing versus when it's all low income, right? So it's a balance, which is why workforce housing is a big deal, because it brings a balance of people into the area. So it's not pushing up rents so high to where everybody else can't afford it, but also you don't have like an all low income building as well. So I think it's just a balance, which is why that 20% threshold is low enough to where you don't have a mix of high income people and, you know, lower income people.
In your low income, or I'm sorry, affordable income housing units, what's the delinquency look like there compared to other units?
That's a good question. So delinquency, I would model it after what that looks like for project-based vouchers.
Okay.
Yeah, and because government is, when it's, and project-based is the formal name for Section 8.
Mm-hmm.
Yeah, and you know, that check comes on time every month.
Yep. Yeah, that's one of the great things about it is it's not the tenant paying, it's the government paying, and they just pay at the same time every month.
Yeah, and I know everybody has their own opinions about Section 8 tenants and, you know, what that may mean. But remember, my development is senior housing. So I'm also dealing with a different type of tenant as well, elderly, you know, typically.
Tell us about that. You mentioned already that it's a service-based model and you have to underwrite that. What do you mean by service-based model and how do you underwrite it?
So this is why this was interesting. I'm not an affordable housing developer. I'm not a senior housing developer, right? But it's interesting because I was modeling it after assisted living. If anyone has an elderly parent or grandparent who lives in a nursing home, the state pays a certain dollar amount for it. Nursing homes are super expensive. Or you may have someone who lives in assisted living where they can still be independent and they can be, you know, they can move around, do things on their own, but they just may need some assistance with some of the activities of daily living. Assisted living costs the state much less than it costs nursing homes, sometimes 3 to 4 times less. Now, the thing with assisted living is usually a private pay product. So assisted living would cost the private person $5,000 to $7,000, $8,000 a month, depending on your market. So in Miami, I think assisted living, the average is like upwards of $6,000 to $7,000 for a decent type assisted living. And then if you wanted luxury assisted living, that's like 11,000 plus for the luxury side. The average senior who's on a fixed income can't afford that. So what the state does, once the senior is determined that, you know, they can't live at home by themselves anymore, either because they've aged out of their homes, which means that they might have had a 2-story home and it's hard for them to be mobile, going up and down the stairs, getting in and out of the shower, you know, maybe they're in a wheelchair. The state generally would say, okay, we'll put you in a nursing home because there is a shortage of assisted living units. And that's where the gap is. So in America, in the next 10 to 20 years, they're calling it a silver tsunami where the population will be aging. So all the boomers are going to be in that elderly assisted living age range in less than 10 years. I think the number is going to shift from like 25% upwards of the population will be in that. So in the past 5 years, a lot of developers were focused on senior housing because that's where the market opportunity is. When I talk to my capital markets people who are like broker dealers and they raise money for big deals, senior housing, independent living, assisted living was like the big new category, just like industrial. Light industrial is very sexy and hot right now. So because we have, you know, a country where a quarter of the population is going to be considered senior, that was my thesis, right? And then secondly, assisted living is not an affordable product, but more seniors could live in assisted living and should not be living in nursing homes. Nursing homes are like when you just need absolute care for everything. Assisted living is in between. So because of an operator that had educated me. The state will pay for assisted living through Medicaid waivers. So you don't have to pay for yourself if you're in a fixed income and at a certain threshold of an income. So imagine going from paying $4,000 to $6,000 a month in assisted living for yourself, and now qualifying for Medicaid waivers where the state would pay for that. So that's the service side, which is why this model was attractive for me. So you have the real estate side where you make the cash flow from the rents, and then you have the service side where you're essentially providing services, 3 meals a day, medication management, housekeeping. It's based off of what their need is. Wellness activities, you have assisted living communities that are very nice. They have a gym, they have a community center, a movie theater, and all of those services you provide, that's a charge to the state. And the state pays for that in Medicare.
So when you're talking about affordable housing, but it's also senior living, is the state paying significantly higher rents per month? And do they pay the market rate, or I'm assuming they don't? How much of that do they?
So it's still the same. And that's the oxymoron. How is it assisted living affordable, right? And so there's only been 2 done in the state of Michigan, because they're also realizing, wow, assisted living, you can do affordability. So what I've done is split the project, separated the housing portion from the services portion, and I'm underwriting just based off of the housing, because that's the affordable side. So the rents still remain affordable, and that's what the state would be financing with the tax credits, the real estate, the housing portion. And the services is a different model that just generates the cash flow and the incomes from the services that are provided.
That's a really interesting business model. Very interesting. All right. Do we have any other questions here for Fabiola?
I've got a question.
Yeah.
So Fabiola, you mentioned that when it comes to income or affordable housing, the developer makes a lot of the money up front. Now let's entertain the sale of the property, but from the buyer's end. So being an affordable housing project, you talked about cash flow is going to be a lot lower, like it's almost a 60%, right? So what are the benefits of buying an existing affordable housing project?
Yeah, so if it's still within its tax compliant, besides the real estate value, right? And knowing that perhaps the real estate value could increase, sometimes it's also from the cash flow side. The rent might be based off of, say, 2017 HUD levels. And here we are, HUD has increased rents at 2022, and there's probably, say, $100, $200 gap in that. So that could be an upside. So you really have to analyze it from a couple of different perspectives, which is the reason why sometimes you wonder, how is this deal penciling in? Not affordable, just a market rate deal. How does this pencil in? Because sometimes the sponsor is just looking at it from a yield play, because they're not expecting to make so much on the cash flow, but on the value of the building, because of location, because of whatever the case may be. So for affordable, you would have to look at it from both sides. Is there an opportunity where the affordable rent is lower than what's being charged? And then obviously the real estate side as well. And then one more. Let's say the compliance period has 3 more years left. You could be purchasing it now in anticipation that in 3 years, I can push it up to market.
So in theory, are you devaluing the property by taking on an affordable housing project because you must have lower rates, lower cash flow?
So from the seller side?
Yes.
I wish that was the case, but even when I see these tax credit projects be listed, there's not that much of a devalue. So now, obviously, the Atlanta one is different because it's outside of the compliance. So for him, he's like, whoever acquires this, they're going to get more than $500,000 in rent increase in just year 1. So he's valuing it based off of the pro forma projections. But if you're still within the tax credit compliance period, you would think that it would be slightly adjusted for the ability not to increase for not being able to increase rents the way you would want to. But I mean, real estate is still real estate. At the end of the day, it's still a piece of property in dirt that will never grow, right? There's no more land that's being created. So it's still real estate at the end of the day.
Okay, thank you.
You're welcome.
Any other questions?
Yeah, I was going to share my experience with investing in one of these elder care facilities. Fabiola, I invested in one of these as an LP 3 years ago, and it was supposed to cash flow, 6-9 months after they acquired an existing property. Very sort of a similar deal, right? Where it was an existing property, it wasn't as full as they thought they could have made it, right? It was in Lubbock, Texas. There's only one other unit, one other similar property there. And COVID happened and a bunch of people moved out, right? So that was tough. So we never got any cash flow. And then they applied for PPE and they got some money in and they were feeling better about it. And then the cost of the income went up, right? So the amount they had to pay people to stay in there to work there almost doubled. And that threw all of their NOI calculations out the door. And these are companies that have 30, 40, 50 units each with 100 plus units, per, right? So they're running, they say they've got economy of scale because they've got 4,000 or 5,000 units each. So I guess my question to you is, if these big companies that have these economies of scale and many, many years of running these are having a problem, having a hard time providing return to investors, like, does that concern you? And this is the elder care part. I mean, the housing part, right? Obviously, you've got it down. I'm just talking about the elder care part.
Yeah, well, oftentimes I wonder, how are these deals trading at the dollar amounts that they're trading and not penciling out? And that's affordability aside. So the volume guys is probably the same thing. There's a building, this is like big news in Miami right now. There is a building in the community that's transitioning that traded for $180 million at $500,000 a door. Just 5 years ago, you probably wouldn't have been able to get it for $80,000 a door. And you're looking at what the rents are right now. Like, what was that underwriting like that allowed that to pencil in at $500,000 a door? And so I wonder about that all the time as well. Now, obviously, it seems like with that deal that you're speaking of, COVID impacted a lot of projects in funny ways. So, the dynamics of that and a couple of other things probably just made that deal a little funky. Did it eventually turn back around?
No, so we still haven't gotten any, I still haven't gotten any returns because their NOI was so impacted by the increased wage rates.
Yeah, so the wage was an issue. I'm going through that right now with construction with this project, which is why it's like a hassle right now, because the how we built out the pro forma just back in April and what construction numbers have done is messing things up as well. So the state came in with the second award. If you were previously awarded tax credits based on these assumptions, and now because assumption numbers, your deal just does not pencil out, we have another award that's available to you. But it's just that the dynamics right now is crazy, which is why it's interesting to see how sponsors are going to react on these deals, just because between labor, between construction, between interest rates, and the uncertainty of all of that, it's hard to pencil in, which is why for the Atlanta deal, we went in at one number, and in our best and final, we had to backtrack by almost $7 million. Not because it didn't pencil out today, but when we forecasted for by the time we close in 90 days, what that would look like, we had to do so at an interest rate that was almost 6.5%.
Wow. Yeah, I just thought I'd share that little information, right, for the elder care part. The silver tsunami, everything sort of makes sense on paper. But when you look at the rate, you underwrite based on the historical wages you're paying people who work there, because it's so heavy. It's just so much of your income that goes into paying the people who are working there. But if their expectation of pay is doubled, right, well, all that underwriting goes away.
So I missed that part. So this is assisted living?
This is assisted living, yes.
Oh,
and
so
it's basically independent living, assisted living, memory care, right? All of them have AL, ILMC. And the size of units goes down as the care goes up. right?
Yeah.
So they typically have three different, categories, and independent living would be the least expensive with the biggest unit because you have the least headcount, right? Headcount cost in helping you. And then memory care is the opposite, right? You've got a tiny little unit, right? But you're looking at 24-hour care. And then oftentimes it's got this a la carte menu where the resident can choose, from the different services they need.
Yeah.
So
what's interesting is that the assisted living market is taking a hit because a lot of the nursing staff is not returning back since
exactly.
COVID. Yeah.
Exactly.
So it's taking a hit. And then in elderly housing, you have a much higher turnover because of mortality.
Right.
So your underwriting has to be very conservative. Honestly, any deal that I touch right now, whether it's affordable or not, my underwriting is underwriting for a worst case scenario.
Okay, great.
Yeah, I would not be so optimistic right now in underwriting, which is why I did those numbers for this Atlanta property at 6.5, which is far from where we are right now on the commercial side for a debt of this size. But I just needed to see from a sensitivity perspective, what does the model look like at different levels? If vacancy falls to this amount, if costs increase to this amount, if expenses go to this amount and we have to pay more for admin and for staff, what does that look like? So we did a lot of stress testing and sensitivity analysis for a worst case scenario, just because there's so much uncertainty since COVID and then going into this, end of the year, so much uncertainty. So any deal that sponsors are touching, and actually, Daniel, you're going to be talking about that with us next week. How are deal sponsors adjusting with all of these changing market dynamics?
Yep, Fabiola, you invited me to be on your podcast, right?
Yeah, and that's the conversation. There's a lot of pause for a lot of different reasons, just because you underwrite the deal going in with this model and it can change just in an instant. So, there's a lot of adjustments that have to be made. So it's a great time to invest, but it's also a good time to be prudent as well in your investing and to know what you're investing in and to really understand the numbers.
Okay. Anybody else? Questions for Fabiola? And if there's a little bit of a pause here, you're going to start hearing this from me a little more often. But as an employee resource organization and working with Next Gen Professionals Network, the Intel REI Club can only reach out to other Intel employees via word of mouth. So if you've gotten some value from this club, please go out and invite a friend. Ask somebody who you think would get benefit from this to come to the club next week. Over the past year or so, our numbers have kind of gone downhill. We haven't been on circuit, which usually is a big bump in our attendance. And it's all been through word of mouth. So I really encourage you, please go invite a friend to next week. Next week, we're going to be talking about happy camping capital, which should be fun.
One of the things that I would say about this market right now, there's a lot of categories that are getting more excited. Like I never really looked at the mobile home category, but that's exciting a lot of investors right now. And now you're speaking about the camping site, because when COVID happened and people had to take to more local travel, I think it reconnected people to some of the natural environments around them and some of the more traditional ways to just travel and enjoy. So I'm sure the camping sites have probably seen an uptick since COVID. So, the landscape right now is presenting some interesting opportunities that probably weren't sexy 3-4 years ago.
Mm-hmm. I'm also trying to court somebody who's going to come in and speak to us about oil well land and syndicating oil wells and what that looks like from a private equity perspective.
Wow. Okay.
That's real estate, right?
Yeah.
That qualifies as something we can bring in the real estate club. Sturt.
Sure.
All right. Hey, Fabiola, can you give your contact information if anybody would like to reach out to you?
Yeah. LinkedIn. Actually, from the first one we did in 2020, there's a few Intel people that connected with me on LinkedIn. So I see you guys, moving and shaking and doing everything else. So it's always good to see progress and activity in people's lives. So LinkedIn is like the easiest way to catch my attention. And then my website, iconheritagepartners.com, and then email info@iconheritagepartners.com.
And you'll forgive me, I am a stickler. I have to know how people pronounce their names. How do you pronounce your last name?
Florenville. So
Florenville, okay.
Fleur de Lis, the New Orleans Saints emblem, Fleur. And so, yeah, so people see it, but they're just not sure. But I'm like, yeah, you've seen it. You see it on your cologne and perfume bottle.
All right. Any other questions for Fabiola? And if not, we'll bring the meeting to a close. Oh, I see the attendee number dropping. All right, Fabiola, thank you so much for coming in. Could everybody take themselves off mute and thank her for coming in and sharing with us today?
Thank you.
Thank you.
Thank you so much.
Thank you. Hopefully I shared something that someone could get curious about, at least.
This was amazing.
Thank you.
Thank you. Have a great weekend, everyone.
Have a great weekend, Fabiola. Have a
Thank
great
you.
weekend, everyone.
Bye.
Invite a friend.